Whenever the Federal Reserve even hints at a policy change, the entire financial world holds its breath. But lately, there's a new player in the game that's been reacting in a really specific, almost structured way, and that's Bitcoin ETFs. So today, we're going to break down why these new investment vehicles seem to be reading from a completely different playbook than the rest of the crypto market and what that might mean for Bitcoin's future.
Okay, so at the heart of this whole thing, you've got two totally different forces at play. On one side, you have market sentiment, the fast, emotional, headline-driven stuff we usually associate with crypto. But on the other side, you've got macro strategy, a much slower, more deliberate game that's all about long-term economic signals. And really understanding the difference between these two is the key to figuring out what's going on with these ETFs.
All right, let's kick things off with a real-world event that really put this new dynamic under the microscope. It all starts with a signal from the one institution that can move global markets with just a few choice words.
So the trigger, the thing that set all this in motion, was a key communication from the Federal Reserve. Instead of the market expecting lower interest rates, the Fed's tone kind of shifted, became more cautious. Now, it was a subtle change, for sure, but it was exactly the kind of signal that professional investors are paid to notice and analyze.
And just like you'd expect, the whole market started to adjust. Bond markets repriced their expectations, the US dollar reacted, but here's where it gets interesting. In the crypto space, something else was going on. While the spot price of Bitcoin did its thing, these new Bitcoin ETFs saw these huge structured flows of capital moving both in and out with a very clear purpose.
And this right here gets to the absolute core of it. The money that was moving through these ETFs, it wasn't chasing some quick pump. It wasn't reacting to social media hype. This was institutional capital making very calculated moves based on a high-level reading of Fed policy. It's a completely different game being played.
To really get what's happening, you have to understand that we're basically talking about two different markets for the exact same asset, and they're operating side by side. The easiest way to think about it is like this. The spot Bitcoin market is like a nimble speedboat. It reacts instantly to every wave of news and sentiment. It's super high velocity, driven by emotion. The Bitcoin ETF market, though, that's more like a massive cargo ship. It's macro-driven, its course is planned way in advance, and any turn it makes is a slow, gradual, deliberate process.
Now, the spot market, that's probably what you picture when you hear crypto, right? It moves incredibly fast, it's often dominated by individual traders, and it can be super reactive to headlines and what's buzzing on social media. That's our speedboat, zipping all over the place.
Okay, now let's flip over to the ETF market. It is a completely different world. Here, allocations are planned out as just one small part of a much bigger portfolio strategy. Every single decision gets filtered through layers and layers of risk analysis, and changes often need approval from entire investment committees. This is the cargo ship, moving slow and steady with a clear destination.
So the big question is, who's actually steering this giant cargo ship? To really understand the why behind these deliberate moves, we need to step inside the mind of an institutional investor.
The folks using these Bitcoin ETFs, they're not day traders. We're talking about pension funds managing retirement money, huge asset managers with trillions of dollars under their care, and financial advisors who are building portfolios for the long haul. You got to remember, their goal isn't a quick moonshot. It's all about managing risk and trying to deliver predictable returns over years, even decades.
Okay, so let's actually map this out step by step. How do they make a decision? Well, it all begins right here, with that initial signal from the Federal Reserve. This is like the captain of the cargo ship noticing the weather pattern is starting to change way out on the horizon.
The very first thing a Fed signal impacts is liquidity, basically the amount of cash that's flowing through the entire financial system. The easiest way to think about it is like a giant financial tap. When the Fed raises rates, it gets more expensive to borrow, so the tap gets tightened. When it lowers rates, that tap opens up wide.
So, this change in liquidity, that's the signal to act. Institutional managers see these conditions shifting, and they start to adjust their game plan. If liquidity is tightening up, they might decide to reduce their exposure to riskier assets. If it's loosening, maybe they'll add some. And these regulated ETFs are the perfect tool for them to make those adjustments quickly and efficiently.
And there it is. That's the complete chain reaction, laid out from start to finish. A signal from the Fed directly controls the flow of liquidity. That flow of liquidity then dictates how these institutions allocate their money using ETFs. And those ETF flows are now a huge force that influences the Bitcoin market. It's a direct, almost mechanical link from central bank policy right into the world of crypto. And you have to understand, this is not some split-second gut-feeling decision. It is a formal, disciplined process. First, they get the macro signal from the Fed. Second, that signal gets analyzed and debated, sometimes for days or weeks, in a risk committee. Third, they decide to make a slow, gradual change to their allocation. And only then, as the very final step, is the portfolio actually adjusted. That institutional discipline is what makes the cargo ship move so slowly.
Now, the thing that makes all of this possible is regulation. But, and this is a really important point, regulation doesn't just magically erase volatility. What it does is it organizes who can participate and how they can do it. By creating really clear rules for things like custody, reporting, and liquidity, it builds the solid framework that these big, cautious institutions need to feel comfortable operating.
So, pulling back a bit, what does all of this actually mean for Bitcoin itself? Because this isn't just about a new product. This could be a fundamental shift in how the asset behaves in the entire financial ecosystem.
Well, when you look at Bitcoin through this new ETF lens, you start to see a very different personality emerge. Its movements begin to line up more with traditional macroeconomic cycles. Market liquidity suddenly matters a whole lot more than social media hype. And positioning is guided by long-term expectations, not just short-term speculation. And that, right there, is the single biggest takeaway. What we seem to be watching is a huge shift. Bitcoin, or at least the part of it that's being accessed through these regulated channels, is moving away from being a purely speculative asset and towards becoming integrated into the established financial world.
To put it as simply as possible, for a growing slice of the market, Bitcoin isn't just some fringe digital experiment anymore. It's becoming another tool in the toolbox for global asset managers, an integrated financial instrument that responds to the very same macro signals as everything else they manage. And all of this leaves us with a really fascinating question to think about. As this integration continues, will the discipline of all this institutional capital ultimately make Bitcoin a more stable asset? Or does tying it so directly to the complicated world of central bank policy and global liquidity just add a whole new layer of complexity we haven't seen before? That's something the entire market is going to be watching very, very closely.